Welcome back. As promised, let's get chatting with the management of CARE Ratings. It starts buzzing in trade post their good fourth quarter numbers where they managed to lower expenditures through their though their ratings business was rather flattish in FY21 on account of COVID. But more importantly, what's the projection for the time that we're currently in for this year? We have the MD and CEO Ajay Mahajan joining us now. Thanks a lot, Mr. Mahajan, for joining in. And that really is the first question. You know, you did see a flat sort of growth on your top line going forward. What are the key verticals that will grow in FY22 and what's your projection for the same?
Yeah, thank you for having me. Well, in regard to, the full year performance, just a quick comment that, until the first 9 months, we were relatively behind our FY20 performance. And we were hoping that Q4 would be good for us. Thanks to the more than partial opening up of the lockdown, Q4 posted reasonably good results for us. Our consolidated income went up 16% and our profit after taxes went up 69% over the corresponding Q4 for FY20. That, I think, in a way redeemed our performance for the whole year, and we were flattish on the top line, about 2% up on consol, 1% up on standalone. However, our PAT numbers went up about 9% on consol and about 7% on.
And we do have those numbers.
Now, please.
Go ahead. We're talking about,
Yeah, so going ahead, as far as FY22 is concerned, our view really is that we were relatively optimistic with things opening up. Q4 at the economic level also for the GDP as a whole was a better number than expected. And we expected that momentum to continue into FY22. However, as we all know, and we have been belaboring this point for a while, the second wave of COVID did dislodge some of those very optimistic projections. We were projecting about 11.5% economic growth next year. And as you know, we feed off the credit growth in the economy. Essentially, we are a rating company and our focus is on overall debt raising, either through NCDs and debt markets or through bank loans. And particularly for longer tenors, some amount of working capital, but longer tenors, 3 years, 5 years, 7 years, sort of tying up of long tenor facilities for investment demand. We were hopeful that, of a better year in FY22 until the COVID wave struck. We still remain reasonably hopeful and optimistic that post July, August, the economy will pick up, and we believe that in certain sectors, particularly metals, particularly construction, we would see probably an upswing going forward, and we remain optimistic within the overall, somber mood that unfortunately COVID-2 brought about in the first quarter.
Okay, all right. Mr. Mahajan, if you could give us a rough number. Last year as well we had the wave 1, this year we have wave 2. So for the year, what kind of a growth? Mid-single digit growth, will that be possible for this year or high single digit growth? I ask this because after a couple of years of degrowth, finally there has been some growth, which is good. Investors will like it. Also give us a sense about your market share. What does it stand at currently?
Well, from whatever sort of internal calculations we do, I think over the last 2-3 years, our market share did drop to lower 20s from higher 20s. Yes. I would suspect a drop of about 5-6%. We are making that up, hopefully, over time. We are, as you know, on a very strongly on a transformative path. We are focused on productivity. We are focused on analytical rigor improvement, and we are focused on revenue diversification. So there is a big theme to CARE Ratings going forward. But to answer your question specifically, I would think that the overall revenue growth next year, it's very hard to give a guidance considering, debt markets are all over the place. Last year, just to give you a point of comparison, the credit to industry grew only 0.4% and credit to services grew only 1.6% versus 7% in FY20. So if credit to industry doesn't improve, it's very hard to post a very strong ratings-related income. But let me tell you, we are doing our best to improve our rankings, improve our ratings quality, and improve our market share in ratings, as also working hard to build revenue diversification through our risk solutions business and our advisory businesses, which have all posted a robust Q4 for FY22. Although the numbers, in comparison to ratings are small,
Mr. Mahajan, if you could give us a sense of what exactly is the delta of your business to the credit growth. I mean, is it 1x sort of growth, 1.2, 1.3, or maybe 0.8? Say if the credit growth is 10%, will your revenue 50%, as in 50% higher at 15%, or will it grow lower? What's that multiple, if you could give us a sense?
Unfortunately, that's hard to give, and I'll tell you, I'll explain myself. I don't elude the question lest I create that impression. The answer to that question is tough because there are a lot of, credit growth. Even last year was 7.64 lakh crores of corporate bonds were issued. Now, does that result into ratings, sort of companies' income increase? Honestly, largely not, because some of these issuances have come from BFSI domain, very large banks, large institutions who happen to be cap clients in most rating agencies. So the growth of credit necessarily does not translate at any particular factor into ratings growth unless that growth is broad-based across mid-caps, small-caps and large caps. So that's a very hard question to answer. I'm not being elusive.
Okay, all right, Mr. Mahajan, we'll take your word for it. I just wanted to come back to that market share question. I put down the revenues for the last year. So now you all would be second position. You all would have, just behind, I think, CRISIL, and then it would be CARE, right? You all would be ahead of ICRA.
Yes, that's it's hard to actually give that comparison vis-a-vis a particular rating agency.
Okay.
But let me tell you that about 3 to 4 years ago, CARE was pretty much neck to neck with the strongest competitor in this business.
Yeah.
Felt that the market share did fall over the last 3 years. Our objective is to not be necessarily too relative, but to consider growth in the absolute. And I believe that there is a big opportunity coming for all of us.
All right, Mr. Mahajan, Mr. Mahajan, very, very quickly, because a lot of investors have told us this, that you're giving out a good dividend. 30 rupees of EPS, you gave out around 17 rupees, which is very good. But a lot of shareholders believe that that is not very tax efficient. So the question is, could you possibly look at a buyback if that is more tax efficient than giving a big dividend? Very quickly, sir.
It's a very good question. All I can say to you is that we will take this recommendation to the board. It's ultimately the board's decision.
Got it. All right, Mr. Mahajan, thanks a lot for joining in and giving us all those details. So we will most definitely keep an eye out on that. So that's the management of CARE saying that their growth is linked to credit growth, and if that comes by, they are optimistic of a decent year so far, though impacted by COVID. And as far as the buyback is concerned, of course, the board will decide on that. With that, we slip into a special